Welcome to Energy Unplugged, the go-to podcast focusing on the global energy transition. My name is Evangelos Gazis, and I'm Aurora's head of Southeast Europe based in our office in Athens. Today, I'm joined by our own Rebecca McManus, Research Senior Associate at Aurora's Pan-EU research team. Becca has over 7 years of experience in the energy and sustainability space. Becca, welcome to Energy Unplugged. I'm very delighted you have joined us.
Hi, Evangelos. Thanks for having me today. Very excited to be here.
Today, we will be focusing on Aurora's recent publication of the European Renewable Market Overview Report, but also the upcoming major Aurora Energy Transition Summit, a major event for the Central and Eastern European region that will take place in Warsaw on February 20th, where Becca will be delivering the keynote presentation. Before we dive into our discussion, I would like to invite you, Becca, to provide an overview of the Pan-EU research team and activities. Can you tell us a little bit about the team, the current services and products, and any future plans?
Yeah, so the Pan-European Research Team is one of our centralized research teams at Aurora, providing holistic insights of the European energy system. The team is divided into 3 key thematic areas, so focusing on flexible technologies, renewable technologies, and thermal technologies and carbon. The core focus of the thematic themes are twofold. We have our technology trends team, focusing on developing our in-house expertise on technology trends such as CapEx, cost of capital, load factors, profiles, all of which are crucial and enhance our Aurora power market forecast modeling. However, we also have our strategic insights team that focuses on developing our European external reports covering cross-cutting topics over Europe. In particular, over the last 12 months, the team has published a variety of reports focusing on different topic areas in the energy sector. So these reports cover the European Guarantees of Origin report, which provides our forecast modeling on GOs. We have our European Co-location Attractiveness Report, which assesses the attractiveness for co-location projects with battery energy storage across Europe, essentially to understand the hot markets for development, focusing on the underlying drivers of those rankings, such as policy support, market size, benefits, and also the overall attractiveness of those business cases. But more recently, we published our European Renewables Market Overview Report. So this is hot off of the press. This is what we published this month, focused on providing a guide to navigating the evolving renewables markets across Europe. So covering 28 markets, as well as focusing on solar, onshore wind, and also offshore wind. So it's a comprehensive report tackling key areas such as policy, costs, project economics, to help clients navigate the European market. That's what we've done over the last 12 months, so quite a lot. But looking ahead, we will be looking to focus our next report on European battery storage market attractiveness in Europe. That will be coming out over the next couple of months, which follows a similar structure to the co-location report, but with a core focus on standalone batteries instead.
I would now like to dive deeper a little bit into this recent report on renewables in Europe and put it in the context of the Warsaw Conference. So firstly, what does the renewable landscape look like in Central and Eastern Europe, and where are we moving towards?
I think if we're focusing on those Central and Eastern European countries there, I think there's a clear leader in terms of renewables development today across those countries. Poland in 2023 has reached 25 gigawatts of renewables capacity, of which 9 gigawatts is onshore wind and 16 gigawatts is solar. So definitely driving the way for those European countries. However, we have seen renewables deployment pick up across other regions in that area, closely followed by Hungary, Romania, and Bulgaria. The key trend I think we see across most of the European regions, except for Poland and Romania, is that this primarily kind of been driven by solar deployment to date. Given the kind of radiance levels that we're seeing in those regions and the support for those technologies, this has kind of been the key driver in terms of technologies across the region there. So that's where we're at right now. But I guess you mentioned where do we see things going? So Again, Poland is a kind of clear driver here. I guess one of the key drivers is demand in that region. But I think the thing that we see in terms of key trends that we haven't seen to date, and not only just in Poland, is actually increasing amount of offshore wind deployment across the Central and Eastern Europe area. Poland in particular, we see a significant amount of offshore wind driving that renewables development in the longer term, but also in regions such as Romania and some of the Baltic regions as well. We will see some offshore wind technologies come on there.
Awesome. And have you quantified this in terms of investment opportunity?
Again, this is definitely something we dive into a bit more detail in our renewables report. But I think cumulatively across the whole of Europe, it reaches kind of 1,400 billion opportunity in terms of investments. But if we focus that solely on Central and Eastern Europe, I mentioned Poland was leading the way. So for Poland, we see investment opportunities totaling 116 billion euros split across offshore, onshore, and solar. And then again, the regions closely followed behind that. We see Czechia, Romania, and Serbia. So between 16 to 19 billion in terms of opportunities for investment. So still quite a large opportunity in some of those smaller regions in that area.
Excellent. And yeah, what about the drivers, the underlying drivers for growth? Is it mainly policy, or are there any other significant drivers that you have identified in the region?
Yes, so there's been a lot of key drivers to date. So policy being one of those. And again, we'll see these key drivers being prevalent in future build out as well. I think we can probably summarize this into 5 key drivers for deployment. So these are increasing power demand. We've seen a significant increase in terms of demand in Europe. Since 2015, an increase of over 9% in total demand in Europe. Secondly, policy support. We've seen an increasing ambition from governments setting renewable deployment targets, but also providing routes to market for renewables through government support schemes. Thirdly, elevated commodity prices. So we've seen gas and carbon prices increasing, and therefore we've seen a kind of buoyancy in terms of the capture prices that we're seeing for renewable assets there. Fourthly, we've seen thermal phase out. So in some regions, so GB actually earlier last year saw coal coming off the system for good. And we'll see similar trends across the whole of Europe there with the phasing out of coal and also the phasing out of unabated gas units in the longer term. And then finally, I think the one of the key drivers as well, and quite astonishing, the kind of developments that we've seen in terms of cost reductions for CapEx in particular has been a key driver for the increase in renewables deployment to date. So I think maybe just to put this in perspective, I think since 2015 and to date, in regards to offshore wind, onshore wind, and solar, we've seen between around 50% reductions in the global average CapEx for renewables. So quite a large decrease in overall CapEx there.
I would just like to pick now one of the policies that we have seen have been quite successful in the region, CFDs, contracts for difference. Are contracts for difference still the main driver for growth when it comes to policy mechanisms? And are there any innovative ways of using CFDs? I know that there have been examples in Poland, for example, of combining CFDs with PPAs. Is that something that you see happening more going forward?
Yeah, no, definitely. I think that's something we've definitely seen in the Polish market in particular. I think we've recently, the kind of EU Commission aimed to barriers to the PPA market, so making them more accessible to off-takers. And you explained there just one of the key ways that they've tried to alleviate some of those barriers there, which is enabling the combination of PPAs with CFD contracts. So you mentioned Poland as one of the regions where we see this happening, but this isn't just one of those regions. We actually see this across most of the Central European regions have the ability of combination of renewable subsidy schemes with PPAs. So what this aims to do is that acknowledges the kind of importance of PPAs as a kind of long-term market instrument to support investment decisions for renewables. So really trying to drive the uptake of PPAs. I think in particular, there are differences in terms of how different markets are allowing this combination of renewable subsidy schemes with PPAs. There are differences in the subsidy scheme terms and conditions. I think in particular, I know it's all in Central Europe, but I think Greece in particular is a real interesting one here, which actually allows the suspension of subsidy contracts for 2 years, which enables them to either sign PPAs during that period or just access the kind of wholesale market for that time period. So differences in, yes, they're allowing this combination, but there are obviously differences in terms of how that's implemented on a market by market basis.
Let's now shift to the main challenges for renewable market growth. Developers and investors are looking very closely into the increasing occurrence of negative prices, curtailment across the region. So how big is the risk in the short term, and how big is it going to be in the medium and long terms as well?
Yeah, I think you highlighted two of the key risks. I think there are several other risks that are being discussed in the market and definitely should be considered. And these touch upon weather risks, construction risks, grid connection risks in terms of significant queues. But I think, yeah, you touched upon the kind of two key ones that developers are really focusing on right now, because they are really important to focus on. And the reason why we see an increasing focus on those two particular risks, so negative prices and kind of grid curtailment, in particular grid congestion, is that on the negative price side, we're seeing increasing number and frequency of negative prices across Europe, which will only be exacerbated as we kind of move into the future with more renewables building out, leading probably to kind of an increasing frequency of negative prices. So I think in 2023 alone, just looking at Central European regions, there was between kind of 250 to 500 instances of negative prices over the past year across some of those regions there. It's not only the kind of frequency of negative prices that's interesting to look at, but it's also interesting to look at the magnitude of these negative prices. And I guess the reason for that is there's a lot of key drivers for why prices go negative. And looking at the magnitude of prices kind of tells that kind of story there. And there's a variety of different reasons why we see prices going negative across Europe. In particular, the ones that we see prevalent in those Central and Eastern European regions is renewables. This is renewables that are insensitive to negative prices. What I mean by that is there are clauses in their subsidy contracts which remunerates in negative price periods, or they have a kind of feed-in tariff structure where they're able to kind of bid in negatively at the price of that tariff. And then in addition to that, I think the other key driver that's driving negative prices in that region is imported. So not necessarily domestic generation driving negative prices, but this is imported from neighboring regions. And again, why is this important? Why are regions looking at negative prices? And the reason for this is that in most European regions, renewable assets either have full or partial exposure to negative prices. So what I mean by this is under a lot of subsidy contracts right now, there are clauses that state that when prices go negative, you won't be remunerated in those price periods. There are some regions, and actually quite a few across Europe, that have a X hour rule. This X hour rule is up to that hour, you will be remunerated. However, anything above that hour, you will stop being remunerated, your subsidy contract price. So it's really impacting subsidies, and it's really impacting how developers are bidding into these auctions, because they have to take a kind of forecast on what negative prices are going to look like in the future. And then also for kind of merchant assets as well. This is obviously a big issue for those assets in the market. So that's negative prices. I spoke quite a bit about that, but maybe to move to the other, I also don't want to not touch upon the grid congestion and grid curtailment piece. So grid congestion, grid curtailment, there's kind of two forms of curtailment in the market: economic and kind of technical or grid curtailment. And I think there's a key focus on grid curtailment in the market right now. Key reasons for that is in a lot of regions, assets are not remunerated for grid curtailment. So essentially, this is when the system operator is turning down renewable generation to ensure the safe and stable operation of the grid. This might be due to kind of must-run conditions or insufficient grid infrastructure, but increasingly we see the levels of grid curtailment are increasing across Europe with more renewables coming onto the system because the grid has not been able to keep up with the pace of renewables deployment. So we see the infrastructure is insufficient to meet the levels of renewable generation that we see on the system. And assets, typically what we see as a trend across Europe is assets that have non-firm grid connection offers are not remunerated when they're turned down for grid curtailment.
Perfect. Many thanks. I just picked those two risks because I feel they are the most often talked about. But are there any other significant risks that you have identified in your report?
Yeah. So I think in addition to the ones that I kind of outlined previously, there's also the market saturation risk as well, which I think, again, is going to be a bigger issue the further we get down the time horizon. So with more renewables building out across Europe, we see an increase in terms of market saturation. And how this impacts the renewables business case is obviously it has an impact on price cannibalization, decrease in terms of the overall capture prices that we see for renewables, and therefore the overall kind of business case and IRRs across those regions. So this varies across Europe. We've done a lot of analysis in regards to this across Europe. It's very technology and market specific here. So the more saturated the market is with a particular technology, the more at risk that market is to market saturation. And in addition to that, there are factors such as flexible technologies. So depending on the build out of those alongside the renewables deployment will have a overall impact on how much those prices are cannibalized. But I think maybe to just touch upon some of the Central and Eastern European regions that we see in particular at risk of market saturation. For solar, we see increasingly market risk for Bulgaria, Serbia and Croatia in regards to solar. For onshore wind, we see this impacting Croatia out of those regions. And then for offshore wind, we see Bulgaria in particular as being at risk for market saturation there as well.
So we talked about the challenges. Now let's turn to the opportunities for the renewable space, starting with one of the most fast-growing sectors in the energy market, energy storage. What are the synergies with renewables and how important are the benefits of co-location?
Yeah, definitely. So as I mentioned, we did a kind of whole deep dive report on co-location of renewables with battery energy storage. And I think maybe to touch upon kind of the 5 key benefits that we focused on in that report and is important to highlight here. So there's a variety of benefits of co-locating and with battery energy storage. I think just coming back to some of those key risks that we mentioned there, and in particular the curtailment piece. So battery energy storage is very good at mitigating some of those curtailment risks. So how can it mitigate against those curtailment risks? So instead of the renewable asset spilling or being turned down in those periods and a loss of generation there, the battery is able to charge up in those periods to absorb the excess energy that would have been essentially lost. So very good at kind of mitigating curtailment. But again, there's a variety of additional benefits on top of that, such as cost savings. There are CapEx and OpEx savings, not only on sharing of grid connection, but there are synergies in terms of development and hardware administrative costs as well. I mentioned in terms of the curtailment mitigation piece, but there's also a kind of generation shifting aspect. So that battery is now charged up but isn't able to then shift that generation and discharge in higher price periods. So kind of increasing the revenue that the co-located asset is able to get. Another angle in terms of how it can increase the kind of overall business case there is the revenue stacking opportunities. So there's a variety of revenue streams that aren't accessible to standalone renewable assets, such as ancillary markets, which allows a kind of additional revenue streams beyond what that standalone asset could access alone, kind of boosting the overall revenues that the standalone project would have been able to get. But then also maybe looking at this from a kind of battery angle, why would you co-locate a battery with renewables? You can also kind of avoid the kind of network charges, which significantly impede the battery business case in some regions. So there is a kind of upside angle from the battery perspective there. But primarily in terms of these co-located assets, we see it as a mitigation for renewable assets in terms of mitigating some of those key risks that I mentioned there. Of course, there are things to consider in terms of like optimal sizing, as well as thinking about the kind of overall dispatch. So you won't be able to kind of dispatch the battery at kind of full capacity. That's why it's really important to, when you're thinking of setting up these projects, of how you're sizing the overall battery to renewable to kind of grid ratios there.
You touched on the benefits of physical collocation, which is obviously very important. How about combining technologies, geographies in a wider diversified portfolio, especially in the context of market saturation risk you mentioned earlier?
Yeah, so I think this is what we see increasingly happening across Europe. So you mentioned there, portfolio kind of diversification. So I think we're seeing this on several different levels. So we're seeing diversifying routes to market. So we mentioned that already in terms of kind of stacking CFDs with PPAs as an opportunity there. Diversifying in terms of technology, as you mentioned, but also diversifying in terms of on a kind of regional basis there. And why are developers looking at this? So I guess portfolio diversification can help mitigate country-specific risk, which is related to weather risks, but also, as we say there, in terms of market risk as well, in terms of grid curtailment and as such. So what we're seeing increasingly happen across Europe is developers looking at the correlation in terms of profiles across Europe, and essentially these can act as a kind of natural buffer against weather risks. So when looking at Europe, you can look at where there is low wind speed correlation, and combining those regions and projects across multiple regions, combining those complementary production profiles can essentially leverage and create robust portfolios that mitigate against weather risks, but also some of those market risks as well.
Many thanks. And closing this section on opportunities for renewables, can you tell us anything about the latest trends in the PPA market?
Yeah, so I think what we're seeing in the PPA market is an increase and an uptake of PPAs across Europe. I mentioned there to kind of diversify the routes to market and de-risk projects. So we mentioned there the negative price risk. I think we're also seeing increase in kind of PPAs as well, especially with negative price clauses included in those contracts, to essentially try to mitigate some of those negative price risks in the market. I think how much we see in terms of uptake of PPAs definitely varies market to market, as well as the prices at which developers are able to realize as well, because this is very much based on supply versus demand market dynamics. And this balance between those changes based on a market by market level, based on the level of renewables build out, but also the willingness to pay by corporates. And that's driven by the overall kind of demand for corporate PPAs in the market versus the amount of supply on the renewable side as well. So definitely seeing an uptake. There are still barriers. Obviously, I mentioned that the EU Commission is aiming to remove some of those barriers, but I think this is a kind of region by region topic that governments are trying to push for on a market by market basis.
I would like to finish off our discussion with our usual overrated or underrated section. I will mention some concepts related to the overall discussion and ask for your take on whether these are overrated or underrated. So, green hydrogen.
For now, I would say overrated, but definitely in the future, would maybe move to being underrated.
Cross-border PPAs?
Oh, cross-border PPAs. I think probably in a sense overrated. I think there's quite a lot of risks and obstacles in terms of market specifics. So overrated, I think, maybe.
What about guarantees of origin?
Again, I'm trying to give you straight answers here, but I think if you asked me this question a year ago with prices of €6, I probably would have said underrated. With prices now below €1, maybe overrated if we're thinking about this from a developer angle.
And what about artificial intelligence and data centers?
Maybe underrated. I think this is going to be one of the kind of key drivers for demand as well. So maybe underrated.
Excellent. Many thanks. Becca, it was my pleasure discussing with you today. Thank you so much for sharing your very interesting insights.
Thanks, Evangelos.
And to all of our listeners, thank you for joining us today on Energy Unplugged.
That was Evangelos Gazis, Aurora's head of Southeast Europe, talking to Rebecca McManus, Research Senior Associate at Aurora's Pan-EU research team. Thanks for listening to Energy Unplugged. Do keep an eye on our podcast feed for more in-depth conversations with senior members of the energy industry. The best way to do this is to follow or subscribe to the podcast via whatever platform you use.